Where we're at right now is we talked about the difference between the perpetual and the periodic inventory system. Remember that the perpetual system inventory as a balance sheet account gets updated every time something changes your inventory amount. If you pay for freight, if you get discounts, all of the costs associated with getting that inventory ready for sale will get adjusted directly into that balance sheet account. And what that means is at any point in time, you should be able to take the total in the inventory account, and it should be very close to what's on the floor. It may not be perfect, but it should be close. Under the periodic system, that is not the case at all. The inventory account is an archaic number. It's old. It sits there from the last reporting period until you do your closing entries. So let's say that we've got an annual reporting cycle. On January 1, you're going to have an inventory balance that will be accurate. And then for the rest of the year, it will be wrong. It will be wrong completely until December 31st when you do your closing entries, at which point you will update the inventory value to match a count that has been done. So in between, you do not have the ability to just say how much inventory I've got using that account. Instead, under the periodic system, a series of temporary accounts are created to record changes that happen to inventory. So let's look at how this would go. Let's say we have a company that sells water bottles, and we have now gone out and purchased a supply of water bottles. Under the periodic system, I'm hoping you automatically think of this journal entry. We debit inventory for the amount that we paid, and we credit either cash or accounts payable, however we paid for the item. Under the periodic system, we're still going to credit our payment method. However, the debit cannot be to inventory, because inventory will not get adjusted until the end of the period. So instead, we're going to debit an account called purchases, and that account will be a temporary account that will be closed at the end of the period. If we pay freight under the perpetual system, that increases the cost of your inventory, which means that it is a debit to the inventory asset. It needs to be recorded directly. I'm repeating this a few times because that was a common error that I saw in some of the things I recently marked. Inventory should get increased for the cost of freight. Under the periodic system, we don't have the option to do that. So instead, we create a temporary account called freight or transportation in or freight in, and that account will be considered when we're calculating our cost of goods sold. Now let's pretend that this purchase was on account and we were given payment terms, and the payment terms were 2% / 10 net 30. It doesn't really matter what the terms are. Let's just say that's what they are. So if we're going to make a payment then, I'm going to put some numbers on this. So my payment for my purchase of water bottles, let's say it was $100. So when I make my payment, I'm going to debit accounts payable, the full $100, because that's how much I've paid off. But the amount of cash I pay will only be $98. And that will be because I get a discount. My discount is $2. That discount gets recorded as a credit to inventory. It reduces the value of outstanding inventory. Now, under the periodic system, we're doing a similar entry. We're still going to debit accounts payable and credit cash for the amount that's paid, but that credit to inventory can't happen. So instead, we create another temporary account called purchase discounts. So if we wanted to sum it up right now, the temporary accounts that we have created so far are purchases, freight in, and purchase discounts. There are more though. All right, let's say that one of those water bottles was no good and I had to send it back. So I would get my money back. I would either debit cash or they'd give me a credit on my account, which means I'd have a debit to my outstanding account payable. And I would credit inventory because that inventory is no longer in my hands. It's been sent back and the total value outstanding is now lower. Under the periodic system, of course, we would still get our money back, but we cannot credit inventory because inventory is an account we're not touching until the end of the period. So what other account do you think that we would use? And in my head, I can see all of your hands up and you're saying, well, create a new temporary account. Yeah, a new temporary account called purchase returns and allowances. We would use this same account if we were getting an allowance as well. So if we called them and they decided to give us some sort of discount rather than returning the items. All right, now, when you make a sale of a product, under the perpetual system, you're going to debit however they pay, so account receivable or cash, and we're going to credit revenue. But we also have to do the second part of the entry, where we record the cost of goods sold immediately and credit our inventory balance. This is something that you're going to have to assume. Anytime there's a sales transaction, unless you're told differently, assume it is a perpetual system and you have to record the cost of goods sold at that time. Under the periodic system, all we would do is record the sales. We would not update inventory. So that means when we have a sale, inventory doesn't get updated in the periodic system in any way, shape, or form. What if these people send back some of the product they bought? Well, we're going to create an account called Sales Returns and Allowances, or Sales Returns, and that will be our debit, and our credit will be to a cash and account receivable. But under the perpetual system, we need to also put that item back into inventory. So we debit inventory and we credit cost of goods sold. Under the periodic system, you still debit sales returns and allowances, and that's instead of doing a reversal of the credit to sales revenue. Notice we started off with a credit to sales revenue, but when we reverse it, we use a contra account. We're doing that because it is good practice to keep track of your returns, because returns usually are an indication that there's a problem. And that also happens under the periodic system. And we get our money back. Sorry, we give them their money back. However, we don't update inventory. So there's no entry when we make a sale. There's no entry when we have a return. This does not change the value in our inventory under a periodic system. So let's say we go through the whole thing until the end of the reporting period, and now it's time to figure out what our ending balance is. So under the perpetual inventory system, in theory, we should be able to just look at the balance in the inventory account, and that would reflect what was remaining in stock. The cost of goods sold account should show our expense. However, in real life, that's not actually true. We're not always going to have a perfect recording. We still have to do a physical count, even under a perpetual system. And if you think about the why, there's lots of things that could create reductions in inventory that wouldn't get recorded through sales, through scanning of barcodes. Theft, spoilage, errors in counts. So there still has to be a physical count at the end of the period. That physical count gets compared to the balance in inventory, and if it matches, nothing happens. If it doesn't match, we have to do a journal entry where we adjust. And that entry would be a debit to cost of goods sold and a credit to inventory. So at the end of the period, now the balance is the same. Under the periodic system, we absolutely have to do a physical count. And in fact, without that physical count, we can't calculate the cost of goods sold. Once we have that physical count, we're going to take all of our temporary accounts and we're going to figure out what the balance is. So we start off with the starting inventory. Remember, that's that dusty old number from the beginning of the year. So this is what we said we had left over the last time we did our updates and we went out and did a physical count. Now let's think about all the temporary accounts we made. What could increase the value of inventory? Well, purchases would increase it, and any freight would also increase the value of inventory. It would be reduced by any returns and allowances and by any purchase discounts. So if we start from the beginning balance and we make all of those adjustments, that tells me what our goods available for sale were. So in total, this company had $252,800 available for sale throughout the entire year. Then we do a physical count. How much is really left? Under the periodic system, then we assume that the difference between what we had and what we have left must be the cost of goods sold. Now realize that at this point, there is no cost of goods sold account that exists in the periodic system. You could either create one through closing entries, or through the inventory adjusting entry, or you could actually report all of these items on your income statement. If the count doesn't match what you thought would be on hand, it makes no difference, because remember, we're using that count to determine the cost of goods sold. So that means this entry is sort of baked into the physical count for the periodic system.